You know what keeps me up at night? It's not the headlines. It's not the talking heads on financial television telling you everything's fine. It's the silence. The deafening silence from the people who actually move markets while everyone else is distracted by the noise. Because right now, while you're watching this, something is happening in the gold and silver markets that hasn't happened in over 50 years. And the people who understand what's coming aren't talking about it on CNBC. They're acting, quietly, deliberately. And if you're not paying attention to what they're doing, you're going to wake up one morning and wonder how you missed the biggest wealth transfer of your lifetime. Let me show you what I mean. In the third quarter alone, central banks added 186 tons of gold to their reserves. That's not normal accumulation. That's panic buying dressed up in official language. The People's Bank of China has been on a buying spree for 18 consecutive months. Poland just moved 100 tons of gold back from the Bank of England to Warsaw. Think about that. They physically moved it. When was the last time you heard about a country repatriating their gold? That's not a financial decision. That's a geopolitical statement. But here's where it gets interesting. While central banks are buying, something else is happening in the physical market that should terrify anyone holding paper assets. The premium on physical gold over spot price has exploded. In some markets, you're paying 8 to 10% over spot just to get your hands on actual metal. That spread used to be 2%. What does that tell you? It tells you there's a massive disconnect between what gold is trading for on paper and what people are willing to pay for the real thing. And silver? Silver is even more fascinating because it's caught in this perfect storm that most people don't understand. It's both a monetary metal and an industrial metal. Every solar panel needs silver. Every electric vehicle needs silver. The green energy transition that governments are forcing through? It's going to consume silver at a rate we've never seen before. The Silver Institute estimates industrial demand will hit record highs while mine supply is actually declining. You've got this situation where above-ground stockpiles are being depleted while new supply can't keep up. But let's talk about what's really happening here. Let's talk about the reset that nobody wants to say out loud. You've heard the term thrown around, the Great Reset. Most people think it's some conspiracy theory. But here's the thing about conspiracy theories. Sometimes they're just spoiler alerts. Look at what's happening to the dollar. The world's reserve currency for the last 80 years is being systematically dismantled, and it's not happening through some dramatic collapse. It's happening through 1,000 small cuts. Saudi Arabia just signed oil deals in yuan. Brazil and China are trading in their own currencies, bypassing the dollar entirely. The BRICS nations are building an alternative payment system. India is buying Russian oil in rupees. These aren't isolated incidents. This is coordinated de-dollarization. And here's what nobody's telling you. When the dollar loses its reserve status, when countries stop needing dollars to buy oil and commodities, all those dollars that have been sitting overseas for decades are going to come flooding back home. We're talking about trillions of dollars. What happens to the value of your savings when that happens? What happens to the purchasing power of every dollar you've worked your entire life to accumulate? I'll tell you what happens. You're going to see inflation that makes the last few years look like a warm-up act. Because the Federal Reserve has painted itself into a corner. They can't raise rates high enough to truly fight inflation without collapsing the economy. The national debt is over $34 trillion. Every percentage point they raise rates costs hundreds of billions in interest payments. They're trapped. And when central banks are trapped, they do what they've always done throughout history. They print. They inflate. They destroy the currency to save the system. Now, I want to show you something that most people have never seen. Go back to 1971. Nixon closes the gold window. Suddenly, the dollar isn't backed by anything except faith in the U.S. government. What happened next? Gold went from $35 an ounce to $850 by 1980. That's not a 100% gain. That's not even a 500% gain. That's a 2,400% increase in less than a decade. But here's what's crucial. It wasn't gold going up. It was the dollar collapsing. Gold just measured the collapse. And we're setting up for the exact same thing, except this time it's going to be bigger. Because in 1971, the U.S. was still a creditor nation. We still manufactured things. We still had a trade surplus. Now, we're the world's largest debtor. We've offshored our manufacturing. We run trillion-dollar deficits every single year. The fundamentals are exponentially worse. Let me tell you a story about a man named Paul Volcker. In 1979, he became Fed chairman, and he did something that would be impossible today. He raised interest rates to 20%. 20%. He broke the back of inflation, but he also triggered a massive recession. Unemployment hit double digits. But here's the key. He could do that because the national debt was manageable. Today, Jerome Powell can't even get rates to 6% without breaking something. We saw what happened with Silicon Valley Bank in the regional banking crisis. That was just a taste. So what's the play here? What are the smart money people doing while everyone else is arguing about politics and watching their 401k statements? They're moving into hard assets. They're buying gold. They're buying silver. They're getting out of paper promises and into things that have held value for thousands of years. And look, I know what you're thinking. You've heard this before. Gold bugs have been predicting collapse for decades, and you're right. But here's the difference. This time, the fundamentals aren't theoretical. This time, you can see it happening in real time. You can watch central banks buying. You can see the BRICS nations building alternative systems. You can measure the money supply expansion. You can track the debt growth. This isn't prediction. This is observation. Let me give you another example. In 2008, during the financial crisis, gold was around $800 an ounce. By 2011, it hit $1,900. Why? Because the Fed printed trillions of dollars to bail out the banks. They called it quantitative easing, fancy term for creating money out of thin air. And gold responded exactly how it should. It preserved purchasing power while the dollar was being debased. But here's what's different now. In 2008, the Fed's balance sheet was under $1 trillion. Today, it's over $7 trillion. And that's after they tried to reduce it. The amount of money printing that happened during the pandemic dwarfs anything we saw in 2008. We created more money in 2 years than in the previous 200 years combined. And you think there won't be consequences? Quick aside here. If you're sitting on a significant amount in retirement accounts, I put together a free guide on how gold IRAs actually work. It's in the description below. Covers the mechanics of getting physical precious metals into your retirement account without triggering tax penalties. Worth checking out if you're thinking about protecting your retirement savings. No pressure, just information. Anyway, back to what's happening right now, because the timeline is compressing. The moves that used to take years are now happening in months. Look at what happened with the Japanese yen. For decades, it was stable around 100 to 110 to the dollar. Then suddenly, it crashed to 150. The Bank of Japan had to intervene multiple times. Why? Because they're trapped in the same debt spiral. They can't raise rates without defaulting on their debt. So the currency collapses. And Japan is just the canary in the coal mine. Every developed nation is facing the same problem. Too much debt, too many promises, not enough growth. The math doesn't work. And when the math doesn't work, something has to give. Either they default on the debt, which is politically impossible, or they inflate it away, which is politically easier but economically devastating. Here's another thing most people don't understand about gold and silver. They're not investments. They're insurance. They're the fire extinguisher you hope you never need, but are damn glad you have when the house is burning down. Because when confidence in the financial system breaks, when people stop trusting that their bank deposits are safe, when they realize their government bonds might not be worth the paper they're printed on, they run to the exits. And the exits are gold and silver. Look at what happened in Cyprus in 2013. The banks closed. People couldn't access their money. When they finally reopened, the government confiscated a percentage of deposits over 100,000 euros. They called it a bail-in, took people's money to save the banks. You think that can't happen here? It already has legal framework in place. The Dodd-Frank Act includes provisions for bail-ins. Your deposits become unsecured creditors of the bank. Most people have no idea. Or look at what's happening in Argentina right now. Inflation running over 100% annually. The peso is worthless. People are desperately trying to get their money into dollars, into crypto, into anything that holds value. But the government keeps imposing capital controls. They trap people in a burning currency, and the only people who are okay? The ones who got into hard assets before the crisis hit. That's the pattern throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina, Turkey, Lebanon. The story is always the same. Government overspends. Central bank prints money. Currency collapses. People who held paper wealth get destroyed. People who held gold and silver survive. And here's the thing that should really concern you. The velocity of money is still historically low. That means all this money that's been printed is sitting in the financial system. It hasn't hit the real economy yet. But when it does, when that money starts moving, when people lose confidence and start spending it as fast as they can because they know it's losing value, that's when you get hyperinflation. That's when things get really ugly really fast. The silver market is even more precarious. The entire above-ground supply of investment-grade silver is estimated at around 2 billion ounces. Sounds like a lot until you realize that's only about $60 billion at current prices. Apple has more cash on hand than the entire global silver market is worth. Think about that. One company has more liquid assets than the entire world's supply of investment silver. What happens when just a fraction of institutional money decides to move into silver? The price doesn't go up gradually, it explodes. And we're already seeing the setup. The gold to silver ratio has been historically around 15 to 1. That's how much silver it took to buy 1 ounce of gold throughout most of history. Right now, it's over 80 to 1. That means silver is either dramatically undervalued relative to gold, or gold is dramatically overvalued relative to silver. Given what's happening with industrial demand for silver, which way do you think that ratio is going to correct? Let me tell you about the COMEX. That's the exchange where gold and silver futures are traded. It's where the price is set. But here's the dirty secret. The COMEX operates on fractional reserve. They have claims on far more metal than they actually have in their vaults. It's the same game the banks play with your deposits. As long as everyone doesn't ask for delivery at the same time, the system works. But what happens when people start standing for delivery? What happens when they say, I don't want your paper contract, I want the actual metal? We've already seen stress in the system. There have been multiple times when the COMEX had to change the rules, increase margin requirements, do whatever it takes to prevent a delivery squeeze. Because if everyone who owned a gold or silver contract actually demanded delivery, the system would collapse overnight. There isn't enough physical metal to back all the paper claims. And that's why the premiums on physical metal are exploding. That's why you're seeing delays in delivery. That's why coin dealers are running low on inventory. The paper market and the physical market are diverging. And when that divergence becomes too great, something breaks. Either the paper price has to rise dramatically to match physical demand, or the paper market loses credibility entirely and people stop trading it. Think about what happened with nickel on the London Metal Exchange. A Chinese company had a massive short position. The price started squeezing higher. They were facing billions in losses. So what did the exchange do? They canceled trades. They literally rewound the market and pretended those trades never happened. They changed the rules in the middle of the game to protect the big player. You think they won't do the same thing in gold and silver if they have to? That's why physical possession matters. That's why, if you don't hold it, you don't own it, isn't just a catchy phrase. It's reality. Because when the system is under stress, when the rules are being changed to protect the insiders, the only thing that matters is what you actually have in your possession. Now let's talk about what's happening with the U.S. debt ceiling. Every few months we go through this theater where Congress argues about raising the debt limit. And every time they raise it, because they have to, the alternative is default. But here's what's happening behind the scenes. The interest payments on the national debt are now over $1 trillion a year. That's more than we spend on defense, more than we spend on Medicare. Just the interest payments. And those payments are going to keep growing because we keep borrowing more, and the interest rates are higher than they've been in years. We're in this death spiral where we have to borrow money just to pay the interest on the money we've already borrowed. And the only way out is to either dramatically cut spending, which is politically impossible, or inflate the debt away, which destroys the currency. The Treasury is already doing something called yield curve control in everything but name. They're manipulating the bond market to keep interest rates lower than they should be. Because if rates went to where the market actually wants them, the government couldn't afford the debt payments. So they're suppressing rates through various mechanisms. But that creates distortions. That creates bubbles. And eventually those bubbles pop. Look at what's happening in commercial real estate. Office buildings are empty. People are working from home. Property values are collapsing. Banks that lent money against those properties are sitting on massive unrealized losses. We're talking about hundreds of billions in potential losses. And those banks are the same ones that hold your deposits. See how it all connects? The financial system is interconnected in ways most people don't understand. When one piece starts to fail, it creates a cascade. We saw it in 2008. We're seeing the early stages of it now. The difference is, this time the Fed doesn't have the same tools. Interest rates are already elevated. The balance sheet is already bloated. The political will for more bailouts is gone. So what happens when the next crisis hits? I'll tell you what happens. They print. They have no choice. They'll call it something different. They'll use different terminology. But at the end of the day, They're going to create more money to paper over the problems. And every time they do that, every dollar you hold becomes worth less. Not worthless. Worth less. Your purchasing power erodes. Your savings get debased. Your retirement gets stolen through inflation. And that's why gold and silver aren't just for preppers and conspiracy theorists. They're for anyone who understands basic math, anyone who can see that the current trajectory is unsustainable, anyone who wants to preserve their wealth through what's coming. Because here's the final piece that ties it all together. We're not just facing an economic reset. We're facing a monetary reset. The entire global financial system that's been in place since World War II is breaking down. The dollar's dominance is ending. The petrodollar system is dying. The BRICS nations are building alternatives. And when that transition happens, when we move from one monetary system to another, there's going to be chaos. There's going to be volatility. There's going to be winners and losers. And the winners are going to be the people who positioned themselves correctly before it happened. The people who understood that paper assets are only worth something as long as people have confidence in the system. The people who moved into hard assets that have held value for thousands of years regardless of what government was in power or what currency was being used. Gold and silver have survived every empire, every currency collapse, every financial crisis in human history. They were money before governments existed. They'll be money after this current system fails, because they have properties that make them ideal for storing value. They're scarce, they're durable, they're divisible, they're recognizable, they can't be printed, they can't be debased, they can't be created out of thin air by a central bank. So when you see central banks buying gold at record pace, they're not doing it because they're stupid. They're doing it because they know what's coming. When you see billionaires moving into hard assets, they're not doing it because they're paranoid. They're doing it because they have access to information and analysis that tells them the current system is unsustainable. The question isn't whether a reset is coming. The question is whether you're going to be positioned correctly when it happens. Because the window is closing. The moves are accelerating. The timeline is compressing. And once the crisis hits, once confidence breaks, it's going to be too late to protect yourself. The premiums will be even higher. The availability will be even lower. The options will be even more limited. This isn't about getting rich quick. This isn't about speculation. This is about preservation. This is about making sure that the wealth you've spent your life building doesn't evaporate when the monetary system resets. This is about having a lifeboat when the ship goes down. And the ship is going down, not because I say so, not because some guru predicted it, but because the math says so, because history says so, because every fiat currency in history has eventually failed, and ours is no different. The only question is timing. And based on what we're seeing, based on the acceleration of events, based on the moves the smart money is making, that timing is getting very close. So pay attention to what's happening. Watch what central banks are doing, not what they're saying. Watch where the money is flowing. Watch the physical markets, not just the paper prices. Because the truth is in the actions, not the words. And the actions are screaming that something big is coming. The final countdown has started. The reset is coming. The only question is whether you're going to be ready.